Hello folks, welcome to Pro Trader Strategies webinar. This is swing trade using options, and I'm sorry, but I am going to try and stay very still because for some reason my camera wants to autofocus throughout this entire video. I've been trying to fix it for about 30 minutes now and it just won't fix itself. So I'll try and be calm and not come any closer to the camera while we're talking about this. Even my hands are doing it, I can see. All right, so swing trades using options. This is for the pop and the drop. We've done directional moves on the bullish moves, market neutral, and even bearish moves. Now it's kind of in a situation where you're looking at the charts and you're wondering, I really don't know. I think it's going to pop or drop, but it's just not going to stay here. I know that. And there's a lot of times where we see things happening in the markets. Tesla's doing it right now. We even talked about that for an example last week. Volatility's moved up a little bit, so I don't know if it's necessarily going to be the best strategy for Tesla right now, but I have found a couple of other opportunities that we will talk about during this video. So throughout this video, if you find something that's helpful, like makes that light bulb go off in your head, please hit that like button. It's like throwing a cookie to one of those bots out there in the Twitter sphere or in the interweb, and it runs out and finds somebody like you to introduce to this video. So please hit that like button so we can feed those bots. Comment throughout this video. As a matter of fact, I'm looking at airline stocks right now. Do you think airline stocks are going to pop or drop in the next month? Throw it over there on the side in the chat window. We will be talking about pop and drop the entire time and how we find opportunities like that. All right. So please do that and comment throughout the video. Like I said, subscribe. Oh, that's what I meant to talk about. Subscribe. Hit that little bell right next to it because I do spotting the trade videos that are a little bit ambiguous as to when I'm going to be doing those because it's really when I spot the trade. So if you got the light or that little bell, the bell right next to the subscribe button clicked, then you will at least get a notification. All right. So without further ado, let's get on with swing trades using options. First off, though, let's talk about what are swing trades. Well, sharing the screen, got that. All right. We're going to be doing the long iron butterfly, but ultimately we are going to end at the long iron butterfly. Okay. We don't go into today or tomorrow thinking, you know what? I saw this webinar yesterday. Wolfman was talking about the long iron butterfly. I think I got to put that on today. No, it doesn't really work that way. What we need to do is come up with our directional assumption for that underlying and then find the option strategy for that. Okay. It's not find the option strategy and then find the underlying. No, what we're doing is going through a process. And what I tried to do here is to help you through that process in order to find the optimal option strategy for that given assumption. All right. We're going to end with the long iron butterfly, but I want you folks to go through that process with me. All right. First off, swing trades. What is a swing trade? Well, when we're looking at markets, right, we often will see the markets make moves, right? I guess you don't want to work for me today. Why is my pen not working there? There we go. So markets, is there something going on with my pen that I'm not seeing why that's not working? It was working earlier today. Doesn't seem to be wanting to work now. Let's see if it works on this page. That page, it works. All right. All right, let's just go to this. I want to do it on this page. Sorry. What is swing trading? Let's talk about that really quickly first. What we're doing is looking for markets. For some reason, why doesn't this pen want to work on this page? All right. We're going to go here. What is swing trading? Ultimately, what we're going to do is look for markets. Sometimes they will. What's going on here? Why is my pen not working? Maybe it doesn't like that pen. Let's see if it likes this pen. Nothing. All right. Oh, my pen is not calibrated right. Sorry, guys. You look fuzzy. Oh, I know. I can't move because my camera keeps auto-focusing. I'm sorry, John. And for some reason, my calibration on my pen is off now. All right, swing trades. What we're going to do is look for markets that move in directions, right? So this would be like a bullish trend, market neutral trend. Sorry, folks, my pen is dead. You can tell that it's not working out very well. So market trends. Ultimately, what we want to do is it a bullish trend, market neutral, or bearish? I don't know what happened to my pen here. Let me actually, I'm going to switch it up here and use a different pen here in a moment. All right. So here what we can do is we can see that this is ultimately a bullish trend, right? So that's the first thing that we want to look for, is the overarching trend for this underlying. I'm going to switch my pens up here because that one, for some reason, does not seem to be wanting to work here. So let's just try to go to a different one. Are you working for me? All right. So when we're looking for a swing trade, what we want to find is look at the underlying. This pen, why all of a sudden my pen calibration is not working? All right, let's go back to this one. Ultimately here, we're looking at a bullish trend, right? Glaze your eyes and you'll see that this underlying is making moves. And somebody was even talking last week, I think about, what was it in the Elliott waves? This is probably looking pretty close to an Elliott wave just because of that long stretch out there, but we don't ever get the correction in this one. And we're trying to find, support and resistances. So we can see here, we got resistance, support on a bullish overall trend here. Then we're going to be looking at market neutral. We can see that this is trending sideways here, and we can see where the resistance line is, where it starts losing momentum to the upside and gains support on this downside here, okay? So that's what we're looking for in this type of trade. And then we're going to place our trade on the pattern. When the pattern reverses, something like this is what we're looking for. We've got a nice big candle at the top of a move, confirmation to the downside. That is a reversal in the pattern there. So that's what we're looking for. Not the overall trend necessarily. That gives us good guidelines as to support and resistance around this underlying, whether it is in a bullish directional move or a bearish directional move. Okay, so we're trying to find those support and resistances around that. Can you reduce your face size below? Yes, I can. I will reduce my face size so you guys can see that. I meant to do that. There we go. Is that better? As a matter of fact, maybe I should just get rid of my face so that it doesn't keep auto focusing. So we're ultimately going to be looking for candles that look like this at the top of a move. And if you're newer to trading options, wait for that candle to get confirmed, meaning there's a big red candle right next to it, okay? If you're newer to options trading, that's what I would suggest. Look for this as, hey, you know what? I need to be on my game. There's something about to happen here. Next day you get a confirmation. That's where you would look for a bearish pattern setting up there, right? We got the setup and then the confirmation. We would add a bearish trade to that. And then we have a bearish overall trend. And then you can kind of glaze your eyes here and see that this is a resistance, more of a support here, right? So you would want to look for the shift in momentum on these types of issuance when they come down and touch that area. Now, if it blows through your support area, you're not setting up the trade there. You're waiting for that pattern to reverse, and you would ultimately wait for it to come back into this trend channel that we've kind of set up. So that's where you would get that pattern reversal, not always just when it breaks outside of it. Hey, it's going to go back into that trend channel. No, it doesn't necessarily do it that way. We have to wait for that to start coming back in on it. Did I zoom in on that chart enough for you guys? You guys, Nayaz, did you get that? All right. So what happens? We will see the underlying bust through. We got this set up. We're looking at it like a trader that has a higher risk tolerance might set up on this, get involved in a pattern swing on this particular movement. You know, it looks very similar to this one with the confirmation, though. There's no confirmation here yet. And lo and behold, if you didn't wait for the confirmation, you didn't get one. This one actually looked like when we opened up in the daytime that it was going to start looking pretty bearish, but late in the afternoon, massive rally blowing through that resistance area. Now, if you had set up on this trade, you should be out when it goes above that setup wick. So if you were involved early before the confirmation, you would want to get out when it goes above the previous day's wick. And it blew up to the upside. Now, when we were looking at this, we were selling calls way up here above this area, so we weren't ever really tested too much. We had two resistance areas, this one and this one when we were setting up this trade, so I was pretty comfortable with it. Yeah, this trade was looking like a loser right away, but my strike location was above that wick there, so I was, or even that resistance area, so I was never really in jeopardy, really. The market did start correcting on that. Again, you could set it up on the doji when it comes down close to the support area, right? Now, if you are trading stocks, folks, you are looking at it to come down and hit that line before you are even thinking about putting on a swing trade, okay? The beauty in options is you can get into these a little bit earlier, all right? So that's why I like using options. You can get in a little bit earlier, and in this case, we were selling puts down here and the I keep reaching for my pen, at the 415 level. Now, yes, we can see that market's setting up. You know, you would have to wait for it to hit that line if you were going to wait for a stock trade or an ETF in this case. Whereas with me, I had the volatility and everything else. I'm able to get down there away from where the underlying is trading and take advantage of a bullish move, right? Well, maybe it broke down the next day and slid outside of this trend channel. Now, again, if you're in stocks, folks, you should be getting out of this, or ETFs, getting out of it when this pattern's broken. The beauty in the options is we are able to get further away from where that underlying is. So we can implement more opportunities around our assumptions, okay? Because we have higher probabilities of success using the options. So, again, identify the trend, right? That is whether it's moving bullish, market neutral, or bearish, right? Then we're going to be looking for identifying that support and resistance, kind of glaze your eyes, find that support and resistance, and then ultimately we are setting up the trade on the pattern. This is what we're looking for. The market comes down, hits that support and reverses back. We would look for a bullish pattern set up there and a bullish trade, okay? So that's ultimately what we're looking for. Now, in the pop or drop, it's kind of at a point where it's just not doing anything. We're really kind of struggling with a directional assumption, but the underlying is just not going anywhere. We think that something's going to happen here. I threw out there with the airlines. They've had all kinds of headwinds and everything else. Well, are they getting some tailwinds and ready to get a pop? Or is this whole pandemic Delta variant circling back around to come to haunt us? All kinds of things with China supply chain, all kinds of headwinds heading into the holiday season. We can make a scenario for either one. So with the airlines heading into a holiday season where most people are going to be traveling, are we going to have a lockdown? Or is it going to negatively affect them? Or is it going to open up and people are going to be with the roaring 20s and traveling everywhere? So that's kind of my thesis with this trade in the airlines, is they could pop or drop. I don't know at this point in time. But why are we using options? We have better odds, and I would love to write with my pen rather than we have better odds. Writing with a mouse is so fun. Better odds, because when I'm trying to use my pen, it's going over to the other. Better odds. Better odds, better margins, and you know your risks, all right? You know what your risk is on this trade. When you're doing stocks, you don't always know your risk, right? Well, with this strategy, it is defined risk. We're going to know immediately at the onset what our risk is and what our potential reward is, all right? So that's another reason why I'd like to use options, right? If you can create a defined risk strategy, you know, you're going to have less stress as well. Lower margins, you can create a more hedged portfolio or a better portfolio with even $10,000. I show you how to do that in some of my webinars. If you want to check those out, make sure you go to Pro Trader Strategies. I have all kinds of webinars on portfolio management and stuff. And, you know, when you are, when you know all your risks, all your rewards and all those, you can stay more mechanical here. You're going to be able to stay in these trades longer rather than constantly fearing the underlying opening up tomorrow in your face, right? This has the defined risk strategy. Another thing that we noticed with this trade, we got that rip to the upside again, but the market started rolling back over. We could, as a matter of fact, it did come back down into this area later on. We saw it pop back, but IBM hasn't gone anywhere for the last 20 years. I started trading this stock in college and it was trading around $100. So this stock really has not gone anywhere since I was trading it in college. And again, with this trade, we can use options where our strike location is more beneficial than if you were going out there and trading a stock and just doing it on the whims of the wind, if you will. And with this one, this is what I'm talking about. With the airlines, they have not been in a tight range like this for quite some time. Now we can see where the support and resistances are on this. If I had a nicer little line there, as a matter of fact, I probably could do, let's just go like this and zoom in on it. So then we can see that we have a resistance area up here. If you kind of blur your lines across my hand there, I think it's going to break out of this little area. Yeah, I've talked about in daily market commentaries or in spot the trades where when you're at the point of control where the most time or volume has been spent, it has a tendency to settle down. Well, it's done that. So when we see it has settled down around these areas, I like to think of it as a rubber band getting wound up, like on one of those old balsa wood airplanes, right? You spin the propeller on it, and the more and more you spin that propeller, the tighter and tighter that rubber band gets, right? Once you release it, that energy comes out, and the propeller spins, right? Well, if you spun it 2 or 3 times, it doesn't spin very much at all. It doesn't have a whole lot of unwinding. But when you've wrapped up a lot, you've built up a lot of energy in there. That's what's happening in the markets when they trade sideways for a very long time, especially in something like the airlines where we've seen a lot of volatility. When is the next shoe to drop? Right now, volatility is extremely low in this one, so we could take advantage of a pop or drop rather easily when volatility or the premiums are extremely cheap. And I'll show you how to figure that out here in just a minute. Okay. What are the options though? A call gives the buyer the right but not the obligation to buy the stock. So if we were looking at something like XYZ stock trading at $100, so I have XYZ, it's trading at $100. If I buy a 105 stock, right? If I buy the 105 calls, or I should say buy a call at 105, I have the right, but not the obligation to buy the stock at 105. Meaning, if I chose to have that be my right, it would go into my portfolio at 105, right? If I buy that call. If XYZ is trading 100, do I want to buy a stock at 105? No. I buy it at 100. I buy it way down here, right? But now during the life of this option contract, we see XYZ start to rally and is trading 195. And if XYZ is now at 195, do I want to buy XYZ at $105? Yes, I do. There's an immense value in that, right? So these options that are in the money or a call option that is below where the underlying is trading has to have the value reflect where the underlying is trading. meaning from 105, my strike 105 to 195, I have to have my strike at least hold that value of $90, right? That's the difference. Now, there is going to be some extra money in that, and that's going to be like theta or some volatility added in there. So there's going to be a little bit more than just the $90 in that premium, okay? So in this day and age, never go through the exercise process, folks. Offset the options, and if I really wanted to buy this stock, go out into the stock market and buy it at 195. Now you might be thinking, hey, well, it doesn't look as good in my portfolio. Listen, I don't care how good it looks in your portfolio. I'm looking at the money you would be leaving on the table, because that 105 call could be worth, like, say, $98 instead of just 90. There could be $8 in extra premium due to theta on there. So you have to figure that math out. If there's $8 in there times the option contract multiplier of 100, that's $800, folks, that you'd be leaving on the table if you went through the exercise process. All right. It will go into your portfolio at 195. It will show and reflect $90 in profit from that spot. But you left the $8 on the table because my options were probably worth $98, right? 90 plus the $8, $98. Okay. Be that $8 extra for the premium. So yes, immense value. I would want to do it, but just offset everything and buy the stock. It doesn't cost you anything anymore. Back in the day, it used to be beneficial to go through the exercise process because it cost you so much to just go out and buy the stock. Now you don't have to pay anything for the stock. So get out of the options, keep that theta, the extra extrinsic value of that option in your pocket, okay? Now, the seller of the option has the obligation to deliver the stock. Now, just say somebody went through the exercise process when it was trading 195 in this example and, just was clueless about the exercise process and options. Well, if that person said to the seller, I want the stock, I would have to deliver them stock. It would go into their account at 105, all right? And even if it's trading 195 in my account, I have to give them the stock at 105, okay? So it goes up. I get to keep that money, though. That collection of credit, you get to keep that, all right? That buyer, when he bought the stock or bought the option, he had to pay for that right. It's kind of like your insurance, all right? The insurance company is the seller. The insurance buyer is you and I, right? The call buyer. And then on the other side of the coin, we have the put buyer has the right but not the obligation to sell the stock. So in this case, if I was a put seller or a put buyer, if I bought a put at 95, which is below where the underlying is trading, it gives me the right but not the obligation to sell the stock. When it's trading 100, do I want to sell it at 95? No, I can sell it at 100. But if this underlying drops to 0, then my puts have immense value and they have to reflect that. All right. But you'd never get that money back that you paid for that option. All right. And the seller has the obligation to take delivery, meaning if this stock went down to 0, well, I would have to give them my stock sell them my stock at 95. All right. I'm sorry. If I'm the buyer, if I'm the seller of the put, I have to buy that stock at 95. I'd love to sell it at 95 if it went to 0. Sorry. If I'm the buyer of the put, I get to sell my stock. If I am the seller of the put, I have to buy that. All right. So anytime you're selling puts, especially if you're newer to trading options, just go into it knowing that you would be willing to buy that stock at that price. All right. And then watch my videos and show you how to lower your overall cost basis on it. I go through that all the time. I show you how to lower cost basis on stocks to 0. I've done that before too. Right during the pandemic, we were going through that, even in those parabolic moves. So if you want to learn how to do that, make sure you subscribe, go to Pro Trader Strategies and sign up for those videos. All right. And if you've learned anything so far, smash that like button, send those bots out there to find somebody like you for me. All right. So we've got the options. Calls give you the right to buy the stock. Put buyers get the right to sell the stock. All right. So there's immense value when they start moving exponentially. All right. So now we've talked about options. We've talked about the fact that there's buyers and sellers of these options, right? There's a call buyer and a put buyer. There's a put seller and a call seller. So buyers and sellers on both sides. Well, when we have buyers and sellers, there's something of value being exchanged there, and that's the price of those options. The price of the options, though, we need to determine whether or not they're cheap or expensive, right? Does anybody know how to do that from this page? Well, what we're going to do is look at Vega. Can you guys see that me shining on this little Vega right there? So what we want to do is look at Vega for this trade. Oh, it didn't go back for me. Never mind. I thought I'd be able to maybe layer a couple of different platforms on top of one another to see if this might work. Trick it into letting me right on my screen, but it's not going to let me. It's not going to let me trick it. Sorry. Anyway, so Vega is in this column right here. You can see that there are a number associated to it. What we're going to do is look at this number in Vega. This is what determines pricing, because as rules for the Greeks. All right, we're looking at the Greeks right now blown up. We've got delta, gamma, theta, and vega. What these Greeks tell us is what happens on an advancement, meaning the stock upticks, the day goes by, volatility increases by 1 percentage point. So it's an increment of 1, meaning the stock goes up by $1, 1 day goes by, all right, volatility upticks by 1 percentage point. Our premiums will adjust by these amounts. You can see I'm looking at the puts right now. So delta is negative, meaning when the underlying moves higher, our premiums in the puts go down, all right? And you got to also think of it as if the underlying goes down, that's a negative plus a negative in the puts is a positive to my position. So that would add into my position on that, all right? And if Vega goes down, then our premiums would decrease by, if it went down by 1 percentage point, my premiums would decrease by 1 penny. All right. All right. So that's the column we're going to be looking at is Vega. And we want to look at the one that's closest to the spot month because that's usually the representation of it. Now, 45 for American Airlines. We can't say by just looking at this page whether or not volatility is high or low for American Airlines. And I'm not talking about the VIX here, folks. VIX is a broader spectrum of all of the stocks, right? Implied volatility tells us what the volatility is for this underlying, all right? I don't care what Tesla's volatility is doing when I'm looking at American Airlines, do I? No, it doesn't. They don't correlate. That's apples to oranges. I want to compare apples to apples. And by doing that, I need to compare this volatility against American Airlines volatility, right? What it's seen in the past. Now, implied volatility is forward-looking. Historical high volatility is hindsight, really, is what we've seen in the past. So I like looking at forward-looking data points. All right. So American Airlines, we've determined it's trading sideways. This is the part of the chart we don't need. And as a matter of fact, I'm going to discount this part of the chart, implied volatility. Why am I discounting this part of the chart? Folks, that was during last year. And I don't know if you guys realize, but it was kind of crazy last year, right? I mean, we had volatility through the roof. So I don't think we're going to see that kind of volatility again anytime really soon. We heard about the Delta variant, all these other things, and volatility has spiked, but we just haven't seen those kinds of spikes like we saw during the pandemic. As a matter of fact, We hadn't seen those kind of volatility spikes even during the financial crisis, folks. So that was pretty significant. I don't think we're going to get back to that kind of black swan event this soon. So I want to discount that part of it. So I want to basically discount the last 6 months or so. All right. So that's basically taking me back to March-ish or something. So let's take this going forward as what we're looking for. So let's zoom down in on that. Again, I'm going to discount all of this out here, right? I don't want to think about that, what happened last year necessarily. So I'm going to take this as the high, this is the low. Because what we know with implied volatility, we need to look at it for this underline. And implied volatility is forward-looking volatility, but it has a tendency to stay in a range, okay? Yeah, we'll break out every once in a while, especially on black swan events like we saw during the pandemic, but it does want to stay within a relatively tight range. So we can take advantage of when it bumps up against the higher areas, we know that's extreme high volatility. And when it gets down below this low area, we know that is low volatility. So if you just were to draw the lines right in the middle at 50%, this is the buy zone, this is the sell zone. All right. So this is the mid mark. So we can see it is below that area in the buy zone. But if you guys want to get, again, to the devil of the details and watch me try to do this with my mouse, ultimately what you want to do is you take the current implied volatility, and I'm really going to go short, minus the low implied volatility. All right, you take that sum and divide it by the high. I'm so sorry, this is so sloppy. High volatility, I know what it is now. I shut off my computer and rebooted it, and I don't think that it kept the settings for my pin tab over here. All right, so the high minus the low there. So the current right now we can see is, let's just call it 48, round it. You can round it. I'm not going to be crazy. 48, the low there is 37. I'm going to say it's just below that. And then you take that and divide it by the 85, which is the high, minus the low, which is 37, right? And we get 11 divided by 48, and basically that's 23%, all right? And what I talk about with the stocks, ETFs, anything above 50 are going to be selling premium. Anything below 50 when you get this number is a buying opportunity, all right? So ETFs, if the 30 mark is usually my high and low for ETFs. They have a tendency to spike but come back down quickly. So 30 is kind of my threshold for ETFs. We talked about that last week a little bit more. All right, so what do we determine with these premiums? Well, they're pretty cheap, right? So what do we want to do? We want to be buying these options because they're cheap. And if we are buying options, we have to be good stewards of our capital. So we have to worry about theta, who's just a thief. That thief just comes and picks your pockets every single night. It doesn't matter how far out the timeline you are, he's still taking something out of your pocket. You may not even realize it, but he is. And the closer and closer you get to expiration, that guy gets aggressive. And it's not linear. So it's not like a penny, a penny, a penny, a penny, a penny. It's like a penny, 2 pennies, 4 pennies, 8 pennies, 20 pennies. Okay, it ramps up like that. And here's actually a good chart for that. You can see further out in time, you would see that this would even level out even a little bit more as you're going out. It's never going to go flat, okay, or negative. It's always going to be picking your pocket. So I like to say outside of 70 days to expiration is your buy zone, and inside really 45 days to expiration is your sell zone, right? I mean, just looking at this, if I sold something here, I would want this kind of erosion happening, right? If I buy it out here, I want this slow erosion. I don't want it to happen quickly, all right? So save yourself a lot of heartache and buy outside of 70 days, if you're buying options, yes, it's going to be a little bit more expensive, but be a good steward of capital. Don't let that theta thief steal all your premiums. Yeah, you're not going to spend that much inside of 45 days, but you're going to notice theta during that time frame, all right? So if you've gotten any takeaways so far, if the light bulb went off, smash that like button for me. If you're a little bit confused, feel free to comment. I'm making sure I'm keeping my eyes on that over there, folks. I want to make sure you guys are clear with concept before you go. And if you don't have time to stick around, make sure you hit the subscribe and the little bell to give you a notification when I pop in unannounced to talk about my trades. All right. So buy zone, sell zone. Well, we've already know that premiums are cheap and I'm going to be buying. So I know that I need to be somewhere out in this area to limit that theta decay. So that thief in the night, we want to go further out in time. We can see on this chart here, we've got theta for the calls. Over here's the puts, right? And we can see that theta is always negative on both the calls and the puts. Why? Because we can't go back in time, right? Every day. You can't get back in time. So this is one day. You can see that it's really ramped up. 29, if we started out here at 90 days, outside that 70 days, we can see that 7 cents a night was coming out of these premiums. You rally or you move forward, fast forward 30 days almost, right? It's increased only about a penny. Let's fast forward again, another 30 days from basically 64 days to 30 days. Look, it's gone from 8 cents, 2 extra cents, right? That's almost doubled its theta decay in a sense, or increased, right? It increased from a penny to 2 pennies, right? So it's increased by about 50% in a sense there. But now look what happens. You rallied forward about another 30 days. Look how much it has increased during that time. It doesn't just jump to 50 cents either. It's like tomorrow my theta might show 11 cents. The next, on Monday it might show 15 cents. So it's going to continuously get bigger the closer and closer we get to expiration. So we want to avoid this scenario. And I'm telling you, folks, if you're watching TV or mainstream media, they're telling you to buy options here. That's the worst advice I've ever heard in my life. Okay? You have to have that immediately happen in your favor. Otherwise, you're going to be losing money. So if that's helped you out, light bulb went off, send that bot out there by feeding it. Click that like button. All right. Now with ours, though, let's take a look at it. Here's the outside of 70 days to expiration. Let's look at my theta for the calls, my theta for the puts, right? It's always going to be negative. Way out here, 85 days. Now it is a smaller stock, so theta is not going to seem as massive. But you can see that due to a rounding error, it doesn't even look like it moved up at all. But coming in closer and closer, you can see that it's moving at a quicker pace, all right? So I want to avoid a scenario where I'm getting involved in this and it starts jacking up, all right, during that time, during those 50 days versus these 50 days, right? These 50 days, it only increased really by a penny. During these 50 days, it increased by 2 pennies. So I want to avoid the extreme ramp up in theta. So I want to go out in time. It's a lot more dramatic when you look at the bigger stocks, okay? It's just going to be more impactful, which is why I wanted to show you that. So if I'm going out in time, I expect a big move. I don't know what direction it's going to go at in this time. I mean, it could pop or it could drop. I don't know which way the airlines are going to go. If all of a sudden everybody says, yeah, we're going to open it up, well, these airlines are going to go crazy and they're going to blast off to the upside. But if we start coming into this holiday season and basically they're saying nobody's going to be able to travel, those airline stocks are going to plummet, right? So a pop or drop is kind of imminent in my eyes. So let's look at the strikes. We're looking at the long iron butterfly. So what we're doing is we're going to be selling a call and a put at around the 50 delta. And then we're defining the risk. We're going to sell a couple of options. Selling those options is what defines that risk, because we can't make any more money if we go through one of those short strikes. So we're defining that risk that way. But why are we selling those two options? Is to lower our overall cost basis of this trade. If I'm buying two at the money strikes, those are the most expensive options I can find. All right, the at the monies. So in order to lower that overall cost basis, I'm going to sell two options that are really close to a 1 standard deviation move. And as a matter of fact, that's the place I'm going to be looking for, is around a 16 delta put and a 16 delta call. Because if you add up all these percentages on this call side going out this way, basically that's a 16% probability. And we know that delta and probabilities are one and the same when we're talking about a standard deviation curve. So I have, with this strategy, very close to a 70% probability of success, right? Because I'm looking for it to go to one of those extremes, right? And delta, we talk about delta when we're talking about the options montage, and delta gives us the rate of change in the option premium, meaning for every $1 move, delta moves our premiums by that corresponding amount, right? I talked about it with calls. If a call move, or if the underlying moves higher by $1, all of the calls adjust higher by the delta. On the put side, that delta is negative. So on a dollar move higher, all of the puts adjust by that negative delta. And on the flip side, if it goes negative dollar, negative plus a negative delta makes that positive position. But what I want you guys to know is that delta is the probabilities, right? We talked about this in the last slide. Probabilities. Standard deviation curve is the same thing as our probabilities. Standard deviations are probabilities. Delta is probabilities. Okay, so we say that delta is just data. On the floor, you know, a 16 delta is a 16% chance of being 1 penny in the money at expiration. 2 times the delta is the probability of touch, meaning the underlying will come up and hit my short call is 2 times the probability of being in the money. All right, so about a 32% chance of that happening. Pretty good. All right, in either direction. 32% chance of that happening during the life of this contract, okay? It doesn't matter if it's 30 days to expiration or 500 days to expiration. The 16 delta is reflective of being 1 penny in the money at expiration, all right? So we're going to go to the 50 delta at the monies or as close. These are all ish, guys. It's never exactly a 50-50. American Airlines may have closed very close to a 50-50, but it wasn't. And the short call and short put, we're going to start out with a 16-ish delta. Now, if you have to come in too tight to like the 20, that's maybe too much volatility in this underlying. Now, I would like to get further out and kind of get around that 16 delta or further if possible. But ultimately, we want to risk 1, meaning we pay a debit. Whatever our debit is, we risk 1 to make 1 in this strategy, okay? Risk 1 to make 1 on our debit. So in this strategy, I tried to go, and a lot of times what you're going to start out with is basically 10 or 15% what this underlying is, and we got a $20 stock, so that's right around $2, right? Well, volatility is so low here, and those at the money still are holding some premium, that we are very close. This is what I was talking about. You can see it is equal skew almost, or it was equal skew at the end of the day, where the $1 down to the $1 higher were exactly the same. Slight skew here, though. But you can see here, I'm looking at buying the 20s. So I'm buying this strike and I'm buying this strike, buying both those puts. All right. And then With that premium collection, you can see I got about $3 and I think it was $3.80 or something. I'm looking to move to where I can risk one to make one. And when I was looking at these strikes, the 12s and the 28s, pretty wide for this one, I was able to risk a lot less than risking one to make one, you can see here. So if you get a little further away, you're risking a little bit more, but your profitability, if you get that outpaced move, are much better. You can see here, I'm not collecting very much at all for this strategy, all right, by selling these. And more times than not, when I'm looking at a stock that's less than $100, that's usually where I'm going to be looking at the straddle on this, because collecting, 35, 40 cents for the strategy really isn't helping me out that much. It's really not lowering my overall cost basis a ton. So usually for me, and I have a higher risk tolerant appetite. So for me, I usually will start defining the risk when I get above $100 stock. Below $100 stock, I'm looking at it like, hey, that $50 or $40 really isn't going to help me out with this strategy that much. All right. So in that case, I might just not define it. But for this video, we have to define it, right? And ultimately, you can see that if we move, we start getting a nice outpaced move, we can get to profitability. Doesn't matter if it goes to the upside or the downside, right? As long as it makes that move. Now, when we're talking about the break evens or your profit and loss, keep in mind you can only lose on one side, right? The other side is making you money in a sense, right? If the underlying flew to the upside, my puts are going to be affected negatively, but my calls are going to be doing great, the call spread. Because really what we're doing is we're combining a call spread, right? Because I'm buying a call at the money and I'm buying a put at the money. And then I'm defining those equal distance away. So I'm buying a call spread and buying a put spread. So if the call spread is making a ton of money, that put spread is probably worthless. So with that, if we're legging out of this, the only thing that take off on this strategy would be the short strikes, okay? So if it blew up to the upside, all right, I'd probably take off my short put because it's worthless. I wouldn't take off the long put because it's going to maybe have a little bit of value. And if it doesn't have any value, there's no reason in taking it off, because if the market just free fell, then that put would actually come back to help you out. So only take off the short strikes when they're worthless, okay? When you can get out of them for zero or a pit, basically a penny or a nickel. It's usually what I look at for that. So the way to figure out your break even, though, is to take the long call or the long put, the long call plus the debit, or the long put minus the debit is your break even at expiration. Now, during the life of this strategy, if we see volatility explode, we will actually see this strategy work out much quicker. All right. If we see a big move in either direction, this strategy will work out much quicker. But we need to have an outpaced move in either direction, because it needs to move enough to make up for that debit we paid. All right. So my break even to the upside, 20 plus the 344, then my break even at expiration is 23.44. All right. If during the life of it goes up to 23.44, like in the next couple of days, it's going to look like a really good winner. All right. So that's when we would look to take it off. But get that move quickly, this trade will work out. If you can cover the negative strikes, the short strikes for less than a nickel, do that. That will increase your profitability potential. And when do you get out on this trade? With this trade, that's what I'm talking about. I'm doing it for a debit spread. You could probably do this as like a 5-day. I have a friend that loves 5-day stops, like especially on debit spreads. If it doesn't start moving within 5 days, I'm just getting out of it. All right. I have no problem with that. For me, I'm putting this on. This is really a great strategy. I talked about this with the SPY for a hedging, where I felt like with SPY, the market was going to break to the downside last week. But I was also worried about the upside. If we got bad economic data, we could easily see the market blast off to new all-time highs, because that means they're not going to lower, or they're not going to let interest rates rise. So I was playing around with that strategy. We got the drop in there, in that not quite as much as I'd like to see, but we did get that drop afterwards, volatility expanding, helping me out. That will work in this strategy's favor as well. Volatility affects those at the money options a little bit more than the out of the money options. So we see that volatility expand. Those ones that we bought will be affected a little bit more than those ones that we sold. All right. So get out. If it stays here, you ever aren't feeling comfortable with it, maybe you get out for a 50% reduction in the debit you paid. That's another rule I like to give out for newer options traders. If you have a high risk tolerance, then I would let this work out for you. All right, play it out a little bit longer. Play it a little bit smaller though, maybe. All right, so get out if it touches one of your short strikes. All right, get out of the long. If it rallies, get out of that long call spread. When it breaches that short strike, you're going to be basically at your max profit for the most part. It's going to be a little bit shy of that, but it will be very close. Just cover it when it hits that short strike. I would, on the put side, maybe cover the short put and then just leave that long put on there for free. I mean, it's basically not retaining any value. I would just kind of let that ride then. All right. In case the market, you covered everything else, the market free falls, you got that free put on, it actually might end up working out in your favor. So don't take anything off, especially on the long put or long call. When those you put on a trade and it's down to like a nickel, I mean, I guess if you need the $5, but otherwise for that $5, I would just let it ride out, because anything could happen overnight. All right, does anybody else have any other questions? Make sure before you guys go, subscribe and hit the bell, because especially during earnings, I'm going to pop in and announce if I find an option strategy to implement around an earnings trade. Now, I don't know what happened with Costco, but I sold some puts in there. So we'll be talking about that in the daily market commentary, or the spotting the trade video tomorrow morning that I do at around 11:30 Eastern. Now, that's the one that you guys should make sure the bell is clicked for, because those are the ones in the morning when I pop in, say, hey, I got this strategy, I want to talk about it. Then you will be all over it. If AAL drops, the put side will help. Absolutely. If AAL drops basically below 23, it will, if it goes to this side, start working out. You can see as we start dropping, that goes higher. And the max loss is if it just stayed right here at expiration. All right. If it moves in either direction on or before that, it will help. And if it rises, then the call side will help. Absolutely. If it jacks up, the call side will help on a rally. Now, something to note, American Airlines is having their earnings, right? John notices that, and John is on top of it because he's got those bells or those gears working in his head. He's thinking, well, if I hold this on with low volatility heading into that earnings, right? Volatility expands around earnings. So I could see this underlying stay right here. But if that volatility expands, what happens when volatility goes higher? The premiums go higher. What's another thing we talk about? Volatility affects those at the money options more than the further rate or the out of the money or in the money options. All right? The further away from at the money. So if it affects the at the monies more, volatility starts jacking up, my strategy will start looking better immediately. All right? But take this strategy off before the earning event. Like, for instance, Costco. Had I had this trade on for Costco, I would have taken it off before the close today, because volatility would have probably been at its highest for this underlying. And then after the earnings, well, There's no more mystery. We know everything, right? We know what's going on with this underlying. So volatility just comes out dramatically, and that will affect your premiums. So stay away from that. You would really have to have the underlying make a massive outpaced move in order to make up for the volatility crush that's happening. Yeah, volatility is going to increase going into that earnings. Those premiums will inflate. But afterwards, you're going to see a massive sudden drop in the afterwards. So you can see a big spike here, massive drop afterwards on their earnings. Somebody else just had earnings. See, this one kind of rallied up after earnings. Who just recently had earnings? Was it? They had a nice spike and then a drop. I can't remember who it was that I was going to use as an example right offhand. But you would love to have something like this heading into that. It didn't even go anywhere, right? So something like this, that straddle going into there, it made a bit of a move there, but that volatility expanding for basically from 80 to 120, that's a massive expansion in volatility, right? And even if it's a penny, right? We just talked about 20 percentage points. That's or 40%. That's 40 cents going into those premiums. Just on that coefficient. Comparing apples to apples, we were looking at our volatility coefficient being about 1 or 2 or something. Well, if this jacked up 40 percentage points, 40 times 1 is 40 and 40 times 2 is 80. So and then we're talking about both sides of the calls and the puts, right? When would you place a long iron condor trade? And when is the ID around 20? When the ID is around 25. So the iron butterfly, iron condors, anytime volatility is low. Yeah, so newer traders, again, I've set for my risk tolerance above 50, below 50 on that implied volatility. Well, if you guys want to do it with a lower risk tolerant appetite, well, do it 75-25. You're buying below 25, you're selling above 75. Does that make sense? That way, you are going to have less opportunity, but you will be getting involved in the extremes, okay? You will be getting involved when it's basically hitting on the barriers. And I have no problem with you guys making it more difficult to making your rules a little bit more stringent. That I have no problems with that. I would just not make them any easier, right? Don't lighten up on these. Okay. All right, then. Without further ado, folks, I'm going to throw this in the chat window for you guys so you guys can take advantage of this. This has all kinds of content, over 15 hours here for you. Where am I at? Copy. Let me get this link over there in the chat window for you so I can make sure that goes out. There you go. There's your link for this. It's a hot link. If you're watching this later on, you might have to punch this into your URL or something, but might as well hit the hot link right there. So it gives you access to all kinds of content. We're going to be talking about everything from how I set up my platform to when, where, why we would implement an option strategy around any given underlying. What's the history of options? That's some fun one. Gamma trades. If you guys ever wanted to do like intraday type of trades, that's when you're going to be taking advantage of gamma expansion and contraction. Also, everybody was talking about the FOMC this week and what they were going to talk about in regards to taper tantrums and all this stuff. Well, you guys have a portfolio of bonds that you probably have never even looked at. Well, you probably should now, because if interest rates start to rise, that bond portfolio is going to get decimated on the pricing. So make sure you guys have that in your wheelhouse where you can stay mechanical with that, get diligent, lower cost basis on those bonds before they start rising. If you're doing it after they start rising, you're basically behind the 8 ball. All right. All right. John said he has subscribed. He is getting, I hope you got the little bell link there so that when I pop in and announce, you'll get that link for it, or at least get a heads up for it. All right. All right, that's it, folks. Make sure you click on that link. And I want to thank you all for participating in this video. Sorry about some of the snafus. It seems like maybe it's better that I just stay blurry all the time. Would you guys rather see me all blurry? probably look a little better. Anyway, here's that link. Thanks you guys all for joining me and participating today. You can reach out to us at 310-598-6677 or trading@protraderstrategies.com. All right. That's all I got for you guys. Link is over there in the side. Subscribe, comment, and hit the like button. Finally, if you can't take that, take it easy. That's the only time I'm going to see that thing adjust. Bye for now.